Good day and welcome to Letters and Politics. I'm Mitch Jeserich. Today I'm very happy to welcome back to this radio program Nomi Prins. Nomi Prins is a journalist, economist, author, former investment banker, and former Wall Street executive. Her writings have been featured in the New York Times, Mother Jones, Guardian, and The Nation, among many others. She was also a member of Senator Bernie Sanders' Federal Reserve Reform Advisory Council. She's written a number of books, a number of which she has appeared on this radio program to talk about. She's the author of a new book. It's called Permanent Distortion: How the Financial Markets Abandoned the Real Economy Forever. She joins us to talk about that book. Dr. Nomi Prins, it is a great pleasure to welcome you to this radio program.
Thank you so much for having me on.
Have the markets ever been connected to the real economy? The financial markets, I mean?
In theory, the idea of the markets was to, among other things, help to raise capital for investments in small businesses, middle-sized businesses, and large-sized businesses. So the idea behind them is to connect to what businesses are at the core of the economy, driving the economy, popping up in the economy. But of course, over the years, the stock market has become sort of the playing field of those that can leverage the money that they have, borrow money to invest it, buy back stocks as if you're a major corporation, and so forth. So it has become detached from the economy with respect to how distorted it's become relative to the real economy, how it behaves versus how the real economy experiences, or real people and experience their lives, has become completely unmoored in the wake of the financial crisis of 2008, and more so, which is why I call this distortion permanent, in the wake of the pandemic of 2020, at the behest of some powerful external entities to the market, of which the Federal Reserve Bank of the United States and other central banks top that list.
Tell me more about the original idea of these markets and investing, and when do you start to see this shift?
Well, obviously from an investing standpoint, markets have been publicly available for investments for centuries, really. But depending on the country and the nation and the type of markets we're talking about. But where I'm actually focused on for this particular period is in the wake of the financial crisis. Why? Because during that time is when all of the external fabrication of money at the hands of the Federal Reserve, other central banks as well, became so uncapped, unlimited, uncontrolled. And it was so obviously done, this creation of money up to $4.5 trillion just in the wake of the financial crisis. It doubled during the pandemic period. But that was done without any oversight, without transparency, without accountability to that money. And what money has done, therefore, in the stock markets is look for the places it can easily multiply itself. I talk about it being like a virus in the book, perhaps because I was writing the book during the pandemic. But the reality is that money looks for the easiest way to multiply, and the easiest way to multiply is the markets, because in nanoseconds and fractions of seconds, money can zoom in and out. And if the larger players have the ability to not just use their own money, but to use other people's money, to use the Federal Reserve's money, to leverage the Federal Reserve's cushion for that money and the philosophy behind that money, well, then they can propel the stock markets much more high relative to the real economy. And I talk about this in the very beginning of the book in terms of just a chart, which shows over this time period how much the real economy, GDP, other factors have just generally been stagnant on average per year, while the stock market, with the exception of this year, has basically just zoomed up and fueled by this external money and how financial institutions and other members of the markets use it.
So you're getting at when the rest of the economy, and we especially saw this in the pandemic, as you said, when people are very scared about their own personal financial situation, yet we still saw the stock market go up and up and up. I used to joke around with people. We know that at some point the sun is going to balloon in size and just scorch the earth. And I said, if that were to happen on an expedited timeline, the stock market would still go up. It would still go up with climate change, et cetera. There's nothing that could stop the stock market. But this is the point that you're getting at, though, is just sort of this disconnect that we see between the markets and the real economy.
Well, right. It's become institutionalized in a way in two steps, the wake of the financial crisis and the wake of the pandemic, in such a manner that even the origins of the Federal Reserve, which is the body that create money the quickest, that can then infiltrate, the rest of the stock market, the rest of financial assets, housing prices, bonds, debt, stocks. I mean, all of the things that money can go into relatively quickly when it's there in abundance for certain players. All of that does not even match what the philosophy of the Federal Reserve was meant to do back when the Federal Reserve Act of 1913 was passed. Now, that said, there's a lot of discussion that I have written about, and other people have, for example, in All the President's Bankers a couple of books ago, and Collusion, my last book, about how the Central Bank of the United States was really created by four bankers and two senior members of Washington's elite. And so what was happening at the time was the idea was there was this body that could help the markets, could help in times of panic and crisis by, as it was sold to the American public, allowing money to not just concentrate in Wall Street and the big money centers on the East Coast, but to basically move through the U.S. economy when it was needed. And that was technically how the Federal Reserve Act was sold. Money will get to the Midwest, it will get to the West, it will get to the South, as long as we have this 12-bank Federal Reserve System that allows for that. But the reality is, what we saw in the financial crisis, and many other examples smaller in history, is that the Fed acts to help the banks. And that's what did in the financial crisis. It created a lot of money under the auspices of helping the real economy, which it did not help on a relative basis, not how people felt, not in the stats, not in the numbers, not in the behavior markets relative to the economy. And this happened, as you mentioned, even more so when we were all locked down. It was almost like it was the perfect, horrific moment where we did not know when the economy was going to open. Companies didn't know. Individuals were shuttered in their homes across the planet. And meanwhile, yes, there was fiscal stimulus. There were checks coming from the government, which was necessary to tide people over. There were PPP loans for small businesses, many of which didn't actually get them because they went through the big banks, and there was a lot of sort of problems, but they were necessary as well. But all of that money was tiny in comparison to the other $5 trillion almost that the Federal Reserve created in a matter of months. And it was back in July 2020 where I saw that the Fed's book had doubled, i.e. they had created in the space of a few months more money than they had created in the years post the financial crisis to supposedly stabilize the economy. But of course, it went into Wall Street and the markets. And that's when I said, and I think I was talking about this phenomenon on some show, this is not just, regular distortion. This is not something that's happening. It's going to go away and we're going to go back to some normal. This is actually a permanent fixture in the financial system and relative to the real economy. And that's where sort of the book came out of, that idea. And we've seen that come to fruition, even now with rates rising and the pain that is causing to the real economy. And even with the markets stumbling as a result of not knowing how much money is going to cost in the near term, they're still outperforming the real economy.
How does the Federal Reserve create $5 trillion in a matter of months?
Well, it's electronic. What they basically do, and it is kind of use an accounting mechanism where they sort of electronically put money into the reserves of banks, and in return for that money, they receive bonds. And from the U.S. banks, for example, those are mortgage-related bonds and U.S. Treasuries, government bonds, that the banks are holding. So the banks basically give the bonds back to the Fed. They get money for those bonds in an electronic transfer. And then there's no responsibility to that money. There's no tie that says, okay, banks, you got to give so much of a percentage to small businesses. You got to reduce the cost of loans for individuals, or just literally anything. There's no responsibility or accountability to that money. So what the banks did, as we saw during those months, is use it. They used it for funding themselves, for buying back stock, for funding private equity companies. And all of what that allowed to happen is big asset managers that do invest real other people's money, retirement funds and so forth, had more momentum and wherewithal to put more money into the market as well. So there was this whole upward cycle that happened really quickly as a result of how the Fed effectively funnel this money through the banking system into the markets.
Was that the single most important driver in the markets going up during the time of the pandemic?
Oh, absolutely. I mean, there was talk all around it to explain that, well, this was based on the hope that the economies were going to open up. This was based on the idea that stock markets are forward looking. And so all we're seeing here is a representation of that. But as we're seeing right now with the markets stumbling because money's becoming a bit tighter, even though most of those trillions of dollars are still in play, we're basically saying that, no, this is complete proof. If it wasn't back then, which I talk about in my book, that this money and the idea that it was there, it wasn't just the money, it was the philosophy behind it. It was the permanent distortion effect of this money being able to be created so quickly and so abundantly that like catapulted the stock markets upward.
So again, the Federal Reserve, I just want to make sure I get a firm understanding of how this works, creates this $5 trillion in a matter of months. I think you said doubling its books. And this money goes only to the banks?
Well, the mechanism is that it goes to the financial institutions that are members of the Fed in return for, again, bonds that they have. So the idea is that it's a transfer. We give you money, you give us bonds. But as long as the bonds stay on the Fed's book, the money stays in play, right? So it's kind of like, it's a bit gimmicky in that respect, because even now, with tightening and with the Fed having said they're going to allow what they say, how they call it is bonds to roll off, or just basically to mature and not buy more at this particular moment. Even the pace that they suggested they would do that at hasn't met up with what they've done. They basically kept the money out there for the most part and kept the bonds on their books. So yeah, it does go through the financial system. That mechanism was in place before the Federal Reserve went on steroids and created electronically so much money in return for bonds. And this idea that it's part of the word that banks could put on reserve assets, quality assets that they have with the Fed in return for liquidity from the Fed, that was pretty much in place since the beginning of the Fed mechanism. But the use, this sort of extreme use, is very new.
Does the Federal Reserve then put conditions, or does it even have the power to put conditions on these financial institutions who receive the money on how they use that money?
Well, the Federal Reserve doesn't. Congress does have the ability to, if they wanted to, both monitor and request and pass laws as to how the Federal Reserve has to behave with respect to the money that it creates. It could pass caps, Congress, but none of this has actually happened. So even in the wake of the financial crisis, where we also saw markets zooming upward relative to the real economy, and the real economy stumbling throughout that period, and certainly throughout the world. We saw credit crunches in 2012 in Europe. We saw recessions poking up around the world. There was civil unrest. There was economic unrest. There was social anxiety all around the world based on money issues and other issues. But so the Fed could impose, but it would require an act of Congress, given the current language of the Fed and how the acts were written and how even the amendments to the acts were written.
That's interesting. And you link this dynamic going back to the Great Recession and the financial crisis that we had in 2008. As you're describing this, it reminds me of a term that we used a lot in the years following the financial crisis of quantitative easing. And we'd have like quantitative easing 2 and 3. Is this the same thing?
Well, it is. It was quantitative easing in the wake of the financial crisis in 3 stages from the perspective of the Fed. Other central banks around the world had their own mechanisms, particularly the developed countries. It's very hard to create money if you're a third world country. I mean, this is really an action of the larger central banks that have larger economies and more sort of prevalent currencies in the world that are used. But yes, quantitative easing was the wonky term for what happened also in the wake of the pandemic. And the definition behind it, I mean, why is it called quantitative easing? It's just weird. It's kind of like, why don't you just call it like fabricating money, because that doesn't sound good politically. It wouldn't sound good to Main Street, but also because what they're doing is, on the one hand, the Fed or other central banks can move the value of money. They can lift the rates for what they call the federal funds rate, which is the rate that the banks basically use amongst themselves. And then relative to that, other rates happen, like your mortgage is X% over something called the prime rate, which is related to the Fed funds rate. There's all these sort of rate mechanisms that they can do just because they decide to do it. And then also they have this other mechanism, which they call quantitative easing. And that's to kind of like tighten the screws a little bit. I say tighten, loosen the screws, or tighten the screws on money as well. It's another mechanism. So the rate that they're setting is based on short-term rates. It's basically on a 3-month rate. What's the cost of money right now between banks to basically borrow and lend amongst themselves, and then that becomes higher as it gets to people and businesses and so forth. Quantitative easing is a way to make that happen for a longer period. So it basically allows the cost of money to go down or go up over a longer period of time. It could just be called, again, money fabrication, money creation for a longer period of time, whatever. But basically, it's a way of targeting the cost of money, not just for 3 months or short-term activities, but over a long period.
This permanent distortion, again, that's the title of your book, that you see with the separation between the real economy and the financial markets. Do you see the 2008 recession and the crisis, and then the pandemic a decade later? Do you see those as sort of a two-step process into this, what you consider a permanent distortion? And calling it permanent suggests that you don't think it's coming back.
That's right. And I do see it as a two-step process. So call it the great distortion and then the permanent distortion. But effectively, why? Because it's not so much the general disconnect between the stock markets and the real economy. That's been there. That's fostered inequality, wealth inequality, and so forth over basically the life of stock markets relative to the real economy. There is always a participation in stock markets that goes to where the wealth accumulates to those that are in it, and it doesn't accumulate to those that are outside of it, regardless of how things are going. But yes, those are two steps that moved us into a permanent distortion, because I do not believe the Fed's ever going to, for example, sell off it's about $8.7 trillion now, but this like a mass amount of bonds that it's holding and ask for its money back. And other central banks are not going to do the same thing. So what we have here is a permanent artificial cushion to financial markets without which they would completely crash. I mean, if the Fed were to say tomorrow, you know what, we're going to sell off our book, it would literally stop finance. And that would have a knock-on effect on crushing the economy. So they're not going to do it. And also, what we've seen is that
it sounds like they shouldn't do that, right?
No, they should. No, they shouldn't, and they can't. So that's why we've gotten to a standpoint where we can't go back. There's no way of unwinding the process by which the markets expect that if there is a crisis that's big enough, that's deemed necessary to deal with in this way of creating money, the Fed and other central banks will do that. And there was a recent example of this that we can look for, even though we're currently in a high inflationary environment, and there's this idea that central banks can somehow do anything about high oil prices or high food prices, which they can't. But that's a bigger narrative around how they can or cannot fight inflation. But what we saw in England, for example, was that the Bank of England has been raising rates alongside the Fed. They have to. Other major countries have to do what the Fed does, because otherwise their currencies lag too far behind the dollar, and that hurts their trading ability with the U.S. And their ability to get dollars to funnel into their system, because the U.S. dollar is prevalent throughout central banks. They hold what they call reserves in dollar-denominated securities. So they need the dollar. But given that rate hiking that happened in the UK, they had a pension crisis, right? So the pension system in the UK was basically facing a tremendous shortfall in its ability to use its government bonds and the interest from those bonds to pay pensioners. And there was an acute crisis that was developing because of how badly pension money had been mismanaged, and the fact that government bonds when rates were reduced down to zero and close to zero in the first part of this process, didn't return enough anyway for pensions. And so as a result, pension managers, big asset funds, borrowed and borrowed and borrowed to gain more and more and more government bonds to just have enough interest coming in to pay pensions. That all came to a crazy halt for various reasons about a month or 6 weeks ago. And so the Bank of England stepped in and created 60 billion pounds worth of money so that it could buy 60 billion pounds worth of UK gilts or government bonds, so it could give money to the pension system that had gotten itself through bad management and also bad central bank policy into such a problem. What does that mean? That means on the one hand, the Bank of England's raising rates, making the cost of borrowing higher for real people. And on the other hand, it's injecting money into the government by buying its bonds to help the pension system because there's a crisis. So this is like a perfect example of permanent distortion, that central banks can't not create abundant amounts of money anymore in the face of a financial crisis. It is their permanent go-to method. And if something like that happens in the United States, the Fed is going to have to potentially go in and buy bonds, which is quantitative easing, while it's raising rates or it's keeping rates high.
Is this something that now it's just going to happen on its own? Because the consequences of not doing it at this point could be severe?
That's right. The markets expect this. And when they don't get it, like even when the Fed doesn't talk about, pausing its interest rate hike, sort of velocity or just, general momentum in it, the markets get upset. So there's an expectation in the financial community and in the markets that central banks will, especially the big ones in the big countries for the big markets, are going to step in and create money to help crises when they deem it's necessary. And just that expectation, which was solidified in the pandemic, it started with the financial crisis to this extent, just the expectation of that is part of what is making this distortion permanent. And that's aside from how, these central banks would fulfill that expectation if they deemed it was necessary.
Is there anything that you could do about this then? Other than go a la, Andrew Jackson and bring down the central bank. And if you did that, I forgive me, but if you did that, then it sounds like there would also be major consequences, economic consequences.
Well, the problem with the central bank is at the source when they do create money out of nowhere, when they've done it these two bouts, right? I'm talking about the Fed, but again, other central banks in different ways throughout the world, the larger ones. That the problem is at the source. When the Fed creates almost $5 trillion and it's ostensibly, to fight a pandemic and a slowdown of an economy, but it's obvious and clear it's going to the markets and not to the real economy. That whole mechanism, that whole accountability needs to be addressed at the source. The cat's out of the bag for that, almost $9 trillion, right? But if there were a mechanism that said, even in an emergency, there has to be a plan. There has to be a why are we creating this much money? How is it going to help? What it's going to help? What's going to happen if we turn around and try to dial some of it back? How much is that going to hurt? The problem is there's no transparency. There's no accountability to what central banks do. And that in and of itself makes the expectation that they'll do whatever it takes. And that's language that all the central bank leaders use. We'll do whatever it takes, up, down. In Europe, in the US, that expectation is still there with again no cap and no accountability. So I mean that's what we can do now. Whether this will happen or not is a completely separate other story, because nobody in Congress appears to understand that by the Fed effectively manipulating money to such an extent when it does, and other central banks, it creates the next crisis, right? So even right now, with the Fed raising rates so quickly, it's actually creating the mechanisms of the next credit crisis. We're seeing mortgages, auto loans, personal loans, credit cards, all of those expenses are going up. as well our delinquencies on payments, right? We're seeing a credit crisis in the making not because rates have been raised, but because rates have been raised so quickly. And because the message is we're going to fight inflation and do what it takes and do what it takes and do what it takes, and we're heroes here, that it's actually sowing the seeds of the next crisis. And what's going to happen? The economy is going to slow down, or delinquencies are going to increase too much, or defaults are going to follow delinquencies. And then the Fed's going to get a call from various banks saying, look, you know what? We're having some problems with their own liquidity. This isn't working for us. And the Fed's going to step in. And whether it's cutting rates at that point or whether it's buying more bonds, injecting more money through quantitative easing, it's going to do that. And so, what can we do about that? Again, it's at source. It's the fact that they're overstepping what should be their mandates and how they do what they do with no recourse and no conversation, just to sort of abandon, an abandonment of just judgment as to whether or not what they're doing is creating more problems down the line. Now, even in the financial crisis wake, I and many writers were talking about how creating so much money, and then it was up to $4.5 trillion by the Fed. And we're talking $41 trillion around the world. So to put all this into perspective in terms of what we're dealing with, that's available right now in total. That this was going to create bubbles. This was going to create, this distorted effect anyway between the markets and what real people are experiencing. Real people living paycheck to paycheck, not having more than $400 in their savings account. All these things right now, our savings rate in the United States is at decades low. Even with supposedly rates going up and incentivizing people to keep money in banks, they don't have the money, right? So there's a stretching of the economy. And again, a lack of accountability as to how central banks have perpetuated this sort of crisis fix situation that we're in.
This is Letters in Politics, and we are in conversation with economist Nomi Prins. Nomi Prins is also a journalist, author, and former Wall Street executive. She joins us for a conversation on her book, Permanent Distortion, How the Financial Markets Abandoned the Real Economy Forever. Thinking about both 2008 and the years that followed 2008 and the pandemic, there has been this argument that Congress's inability, and this is really true for post-2008, did more in the pandemic, but still the inability of Congress, of the federal government as a whole, to be able to address a financial crisis, that the Federal Reserve had to step in, had to use the tools that it had, such as, again, the creation of money or lowering interest rates, and that the Fed had to do everything, had to do more than it would have even liked to do, because the rest of government was so stuck in the quagmire, and wasn't able to do anything itself. And that's part of this dynamic that we're in.
Well, that's what we're told, right? That the Fed's just this sort of neutral victim in all of it, but it's not. First of all, in the wake of the financial crisis, the Fed did not have to create as much money as it did. Again, there was no conversation. There was no question about limits. There was no strategy as to how they would exit. Still isn't. There was none of that. So this idea that, we have to create all this money because otherwise the world's going to fall apart. We can't help it. This is just our job. We're just doing our duty is kind of really disingenuous. If it wasn't on the radio, I use different terms for that. But the fact is that it was the financial community getting to the edge of the risk they were imposing on the real economy by all of the engineering of toxic assets that they were doing and selling them to each other and lending money to each other to buy more of the things that they were creating, and sort of pass this hot potato around the financial community, try to get small towns, pension funds, asset management companies to buy this for real people, these toxic assets at the time. And then when there was problems with them, they were lined with subprime mortgages. When there was problems with the subprime mortgages basically defaulting or not paying into these toxic assets, everything started to crumble. Now, it's the Fed's job to regulate this stuff. It's the Fed's job to talk to banks and to be the arbiter of how healthy banks are, and to get the information, to have the conversations, not when the crisis has already happened, but as they are doing what are sowing the seeds of each crisis. And this was not going on. This was absolutely the Fed's fault. Now, from a regulatory perspective, or laws being passed by Congress, absolutely at fault as well. Congress basically voted to separate, to amalgamate what had been a separate banking system where deposits and loans had been kept in a separate bank, from investment banking, from trading, from taking risks, from creating these toxic assets on the wake of consumer loans and subprime loans.
This is undoing Glass-Steagall.
And this is Undoing Glass-Steagall, which I've written about in multiple books. So Congress is at fault there, in allowing banks to effectively be, sort of major entities that can use other people's money, which was the title of my first book, as fodder for every other risky endeavor that they take. And so that's a legislative problem. But the Fed is supposed to be the regulator of these banks. The problem is the banks are members of the Federal Reserve System, that the banks actually get dividends from the Fed. The banks get paid 6% per year, no matter what happens with them, with the Fed, for the shares that they have in the respective region of the 12 bank Federal Reserve System. So there's all sorts of relationships there that cloud things. But to say that the Fed had to step in or has to step in now is abjectly taking away its responsibility to do its job of regulating the banking system.
Obviously, right now, the big concern and the big news is concerning inflation. Perhaps the journalist in you and the journalist in me thought we should have began there, and maybe I'm burying the news here a little bit, but here we are. How does inflation fit in to this narrative that you're presenting? And has the Fed been a lot of people think all the money that was created, not just through the Fed but also through Congress during the pandemic, has played a major part in inflation. How do you see inflation today?
So first of all, going back to the part that the government did, the $600 checks, the tapping, so the increasing of unemployment benefits and all of that over the time of the pandemic. I mean, that was money that was needed, and it was a replacement for most people and most small businesses for the business that they were losing, for the paychecks that they weren't getting. So if we just think about that part of inflation for a second, it's actually not being the cause of what's going on. Because it's really not. It's one of these false narratives that's been out there. But just in sheer logic, if you're, plenishing people's ability to get paid, and companies to continue to survive because there's been an external kind of enforced shutdown of all of that, you're not inflating the economy. You're basically making it whole at that level, right? So this idea that somehow these $600 stimulus checks or some $1,200 or whatever per family, that this is somehow why we have inflation now, is really unfounded. It isn't why we have oil price inflation, which is largely, related to oil policy and geopolitics, the Russia-Ukraine war and so forth, or natural gas, the inflated prices of natural gas, which are pushing up our electricity bills, for which people are paying more and more with credit cards, which again increases their consumer debt because they can't afford right now to pay for that. This isn't extra money.
Credit card companies have shown that, right? I mean, credit card companies have shown that people are paying
exactly
their electrical bills.
Credit card balances, personal loan balances have been increasing, and they've been increasing while rates have been growing, and particularly now with the inflation of food and fuel prices, because people need to pay to put gas in their car, no matter what it costs, to heat or cool their homes, no matter what it costs, to buy at least food staples, no matter what it costs. So part of inflation is that you have a captive audience that has basic needs, and those needs are rising in price for other reasons. So we had COVID shut down a lot of a lot of supply chains. That was sort of the start of this. And then when supply chains came back on, and when people started working again, yeah, there was a sense of we're going to buy more because we're more secure. But the bulk of inflation has to do with food and fuel, and housing and rent. Now, food and fuel, there's zero that the Fed can do anything about, and there's zero that the Fed actually did to create that inflation. It's not like because the Fed created money that, Russia invaded the Ukraine and then, decided to, muck around with pipelines and, have sanctions, and then Europe having sanctions to them, and the US. And I mean, none of this was related to the Fed. And yet it's one of the main reasons we're facing inflation across other things, because you need fuel for food, you need fuel for manufacturing. You need diesel for trucks to do transport, to get food from A to B, or raw products to be manufactured into food and then getting into stores, and companies taking an increase all along the way that they then pass on to the consumer. And if the consumer again is captive because they need these items, then they pay the higher rates, and that looks inflationary. None of that has anything to do with the Fed. But it's all stuff that we're dealing with now for all of those circumstances happening at the same time. But what the Fed did was notice that inflation was high. Now, the inflation that the Fed had something to do with was in the financial side, so in housing prices. So this gush of money that came in, not just after the pandemic, this gush of money was coming in from the financial crisis too. Home prices didn't all of a sudden escalate just after the pandemic. They escalated by more, but I mean, they were increasing relative to people's salaries for decades, but particularly since the financial crisis. Because again, money was going to the top. It was easier for people with money to get money, right? I mean, it's a lot harder if you're a borrower that has more of a complicated financial situation than if you're a big bank or private equity fund, or even a rich individual buying a second or third or fourth home. That's all easier to get borrowing from. And that's something that we got after the financial crisis, and after the pandemic. So that money that was available helped to inflate that set of housing prices, first post-crisis and financial crisis, and then after the pandemic. Now, we have a situation where home prices are coming down a bit because rates are going up. And so, for example, first-time home buyers are facing double what would be their payment to get the same amount of house or cost of house as they would have in March. So all of a sudden, buyers cannot buy. And sellers, normal sellers, I'm not talking about the multiple homes and the leverage companies and private equity, but normal people don't even want to sell homes now at lower prices because they're locked into lower mortgages. And they would have to refinance a mortgage at a higher level because rates are so much higher than they have been. They don't want to do that either. So yeah, there's a kind of détente going on in the housing market, and prices are coming down, but not enough relative to rents going up. So even though I'm talking about all the aspects of inflation here, we can unpack, but these are all like the main things I think people are noticing and dealing with. Housing prices are going up during the money period creation. They've come off a bit during the rate hike period, but rents have escalated to take up that part of inflation. Why are rents escalating? Again, because people can't buy homes. And again, a lot of homes aren't selling at the level of sort of the foundation of the economy where most people can afford anything anyway if they could. And so there's a stoppage there. And so landlords are squeezing rents higher. And people have no choice but to pay them because they need a place to live. And so again, this is why people are borrowing more at higher rates. This is why a crisis is being created right now. So when we talk about inflation, there's so many parts to it. And when Federal Reserve Chairman Jerome Powell talks about the Fed fighting inflation, and the UK Bank of England just raised rates by 75 basis points, their highest hike in decades, if not forever, I think in one shot. The ECB, the same thing. They're trying to sing this chorus that the Fed has basically scripted of we need to fight inflation. How do we do that? We stop the kind of the economy if we can by raising rates. But again, a lot of the inflationary items have to do with supply and demand and people's need to find a way to pay for them. And so we're kind of in this mess right now, where the people that need to pay for the things that they require to live is getting squeezed and squeezed and squeezed by rates rising so quickly. Wall Street's going to be fine. Wall Street had a great quarter. Why? Because they're trading. They don't care. They can trade up. They can trade down. It just doesn't matter. And they're squeezing more interest out of their customers because the customers are desperate for money. Again, personal loans, credit cards, whatever. So they're paying more, but they're not passing that on to savings. And even if they are, we're at decades low savings rates. So it just doesn't matter as a whole if you look at the entire picture of most people in the country.
The argument for the Federal Reserve to raise interest rates to fight inflation is that then by raising interest rates, you make it more expensive to borrow money. If you do that, less people borrow money. Instead, they save money. If you're saving money, now you're taking some money out of circulation because you're saving it. Hence, that should ease inflation eventually down the road. But it sounds like what you're saying is people aren't borrowing money to buy yachts or go on vacation. They might be doing that, but that's not really at the heart of the problem. What you're saying is people are borrowing money for things that they have to borrow, that they have to have money for to survive.
That's right. There was a study, I think it was Bank of America actually, but there's a study, again, going back to electricity bills, where people are increasing by 40% the number of people that are using their credit cards to pay for their electricity, right? So when you see things like that, and you understand, or we understand, why people need to pay for what they need to pay for, and they're becoming desperate. Then what the Fed is doing is quite cruel, because it's not, again, so much the raising of the rates. It's the raising of the rates so quickly, and so such a sort of message of we're going to fight inflation, just take the pain, you guys. When again, these are people that are not even elected by us. They have, complete job security. There's so many differences between, Federal Reserve Chairman Jerome Powell and the rest of society anyway. But none of that. This narrative is just not reflective of the facts. In theory, yes, if you tighten the cost of money, people will make the decision not to borrow, and they'll just go about their day and they'll save. But saving rates are at lows. Borrowing is increasing. And what people are borrowing for in terms of necessities are being put on credit. So none of that kind of falls into this picture of how the Fed's going to fight inflation for everybody's own good.
What do you think this means for the next couple of years? I'm asking you to forecast here, and it's always a dangerous profession to be in. But what do you think this means here in the near future? I mean, people are scared about inflation. We keep anticipating, keep being told it's going to slow down and maybe even go down. But so far that hasn't happened.
It hasn't happened. And again, a lot of that is because of just general economic factors and nothing the Fed is going to do or not do. So with respect to energy prices, with respect to food, fertilizer, transportation costs, those things that are all interconnected to basically power and energy in different forms are I think going to stay with this inflationary period for a while. We could dip down because people, there are whole production plants being taken out of commission, for example, across Europe, because it's just not cost effective to pay for the energy expenses that they have and make enough money to turn a profit. So those sorts of things where you do have people coming offline or companies coming offline, so they don't require as much energy, and that could dip or have a knock-on effect of decreasing the demand and therefore the price. But that could happen, but that's going to take some time. So I could see inflation staying, pretty high for the next year or two, and just out of the general fact that the economies are slowing everywhere, and we're having recessions building up and credit crises building up and liquidity crises building up, that ultimately that's going to create some sort of an economic or financial crisis, at which time the Fed's going to step in and do what the Fed does, which is aggressively produce money for the markets to stay stabilized. So going back to how do I feel, how do real people kind of, consider their futures? I think prices are going to remain high. Again, they might come down a bit in staples because energy might come down a bit for reasons I just talked about. But I think they're still going to stay relatively high. And the best thing people can do is cut their own expenses by using less. I mean, basically not trying to stretch too much with credit or with borrowing, and just trying to kind of stay put in the environment to just protect themselves. Again, some things are necessities, but if there's a way to sort of shave them down in terms of paying for them as we are in this still high inflation period, and not feel that the Fed's going to be like some savior, which I think most people don't think. I think it's just like the Fed in Washington, and sort of that actually thinks that the Fed's going to make a meaningful impact on what people have to pay relative to what they earn. But to not obviously believe that, and just to kind of, try to sharpen the edges of your own household, your own expenses, really, and just kind of wait it out.
Are times of inflation usually followed by recession? Is this kind of how the cycle works? And it's kind of scary to think about what happens when a time of inflation turns into a recession, because that means prices are high, and once you get into a recession, a lot of people lose their jobs.
Well, yeah, and we're kind of in that gray zone right now because, this most recent quarter, GDP was up, which is one indicator of just economic health. But the last two quarters, it was negative, which technically constitute the definition of a technical recession. But net, we're at zero in terms of economic growth over the last three quarters. So that's not a sign of economic health. And that's while people are paying more for everything that they do and need. So if you take all that away, and people kind of step back and sort of pare back, and then companies pare back, and then companies start firing people, then we do get into a situation where we have rising unemployment and a recession. Right now, we have, I think, more of a recessionary and high inflation period, and the jobs figures show that people are still getting paid and people can still find jobs. But at some point, if companies aren't able to pass on all the costs, which they have been doing, of their expenses on inflationary prices, then they start to cut people. And if there's an uncertain economic period, they start to cut people. And this is why recessions do tend to follow high inflationary periods. We haven't had a high inflationary period until just recently. We've had a very low inflationary period since the financial crisis and going into the financial crisis. So this is a very different kind of situation. But in the 70s to the early 80s, when we did have very high inflation and rates were raised by the Fed, up from basically 11% to 20% over the period of a few years, that did have the effect of slowing credit and slowing the economy and causing a recession and causing unemployment, from which ultimately inflation did go down. But I don't think it was just due to rates rising. I think it was also, this was a cycle that was kind of, sort of working itself out, not just because the Fed happened to have raised rates during that period to supposedly fight inflation. That's the story that we're hearing now a lot, which is why the Federal Reserve Chairman Jerome Powell sort of likens himself to Paul Volcker of that day. But I don't think that's what's happening. I just think that at the time, Volcker was raising rates to fight inflation, and inflation ultimately went down because of other reasons, and they would have gone down anyway had he done nothing. That's what I believe. But that's not what the narrative is out there, and that's not the narrative that Powell is perpetuating, or that, again, people in Washington appear to believe.
Yeah, that hits home. If you're under 50, this is something that you really haven't lived through before.
Right.
I mean, maybe as a kid, but that doesn't count.
We don't remember. But again, like, ultimately what's happening here is people are having, and this is the major takeaway. The numbers are showing that as rates are rising, as the Fed is supposedly fighting inflation, which again, a lot of which is caused by things the Fed cannot control or do anything about, without a prolonged economic recession, which could or could not happen whether they raise rates or not. But the point is, raising rates, what it does is it creates a credit crisis for people in small businesses, and we're seeing more borrowing happen to, again, pay for necessities and for small businesses to survive at higher and higher costs because rates are higher. It ultimately has to be repaid, and that's why we're starting to see also Payment delinquencies happen because people just can't afford it and they don't have a savings. So this idea again that, we're going to all just save money at higher rates because our savings rate is so very, very low. And so the numbers are just showing just a really fragile period for the real economy. Whereas once the Fed steps back from raising rates, which it will, or at least from the pace, the markets are going to like zoom back up because they're going to be like, okay, well, that's over. It's different for people and the real economy. That's where permanent distortion comes in.
Nomi Prins has been our guest. She has joined us for a conversation about her book. It is called Permanent Distortion: How the Financial Markets Abandoned the Real Economy Forever. Nomi Prins, I thank you very much for taking the time to join us today.
Thank you so much, Mitch.